Hey, good evening, everyone. Let me just sort of break the ice a little bit while we're waiting for a few more people to stream in. So, thank you for attending. This webinar was arranged rather last minute. I've actually decided to do it only 8 days ago, last Sunday. And it was primarily because I did a LinkedIn post about the announcement from GRI that they are publishing two new standards, one for energy and one for climate change. And one of my former course from one of the courses I took tell me, I'm actually waiting for him to log in. He commented on my LinkedIn post, are you going to hold a session to explain to us the changes? I was like, okay, maybe I should. And so thanks to him, I decided to do this free session tonight. And also as a way to touch base with most of you who I've not met for a while. There are a lot of familiar names in this webinar. It will be quite a relaxed session because most of the guests are actually not strangers. They were either my friends, my contacts within the industry, or my former clients who have taken my training before. So I just thought that it was a very apt opportunity to both touch base with everybody, as well as go through something which I think is very important because this release by GRI of these two new standards is really a landmark change. Firstly, because the changes are very comprehensive and a lot of it is very different from what it used to be. Secondly, because they changed the topic standards for climate change and energy, which basically are material topics for just about every company. In fact, I don't really know of any sustainability report that does not has climate change or at the very least greenhouse gas emissions data as one of its material topics because obviously it's a very big deal today, climate change. So I think this is going to affect just about every single company in the world that uses GRI for reporting, which I think globally the rate stands at 71 to 77%, depending on how big, where you set the threshold for the size of the company. But certainly in a lot of Asian countries like Singapore, GRI is used by pretty much 100% of the listed companies here to report. So it is a very important change. So it's 9:05. I think let's just dive into the session and it's being recorded anyway. So for those who have to leave early or those who are not able to attend, I will post the recording of the session in another few days or so probably on my YouTube as well as on my website. Okay, so let's jump into the session. Now, tonight we are going to cover not everything that has changed, but very briefly highlight some of the more important changes after my own analysis between the old versions and the new versions of the standard. So we would also talk about a case study, which in this case, I'm going to use City Developments Limited, one of the most illustrious sustainability reporters from Singapore, as an example to show you just how much impact it is going to have on any existing company that uses GRI to do their sustainability reporting. And then we'll end off with a little bit of discussion about interoperability issues versus other standards and frameworks, which is primarily IFRS S2, ISSB, aka ISSB standards, as well as ESRS. And then I will also ask my partner in crime, Joyce, who is with me tonight as a panelist, to do a short introduction of herself while I go through the Q&A. Because I'm a guy, I can't multitask very well, so I'll probably have to stop talking for a while in order to absorb and read all the hopefully many questions that you will have. But feel free to type it in as and when you come across a slide that you want to ask some questions, and I will pause now and then to answer questions that are relevant to the slides I'm talking about, also during the session, so that we don't have to jump back to it later on. But hopefully we'll also leave enough time at the end of this 1 hour, maybe about 15 to 20 minutes to answer more generic questions. Okay, let's get into it because there are really a lot of changes and we don't have a lot of time within an hour to discuss a lot of it. So some background information, and I'll go through this really quickly. The reality was this two standards was actually, these two new standards was actually announced more than 2 years ago in February 2023. And if you look at the timeline, it's quite obvious that, this kind of coincided with the setting up of the ISSBs back in November 2021, and then subsequently they released IFRS S1 and S2 in June 2023. So basically, GRI was already aware that S1 and S2 was coming out, and they decided to update their own versions of the climate change topic standards in order to be to catch up with the developments in mandatory reporting. And with the release of these two new standards, one on energy and one on climate change, they also released a course, which costs Euro $195, to talk about how a reporter should do, or preparer should do, climate reporting in both GRI and IFRS standards. So I paid for this course. It takes about 2.5 hours to complete all the videos, and I watched it to prepare for tonight's session. Because here at CSO Center, we make it a point, as trainers, we try as far as possible, whatever we share with you, we want to obtain the information from a primary source, which preferably is the standard setter, because a lot of stuff that you Google on the internet may or may not have the most correct interpretation of what the standard requires and how you should do it as a preparer of a report. So therefore, I always try to go back to the primary source. And therefore, I took the course, which some of the information that I gleaned from the course, I would include in tonight's session as well. So I'll save you that 195 euros, hopefully. And that will probably give us a better appreciation of just what GRI is trying to achieve. So what exactly got updated? Now, GRI used to have two topic standards that were related to climate change. One was energy 2016, and the other one was emissions 2016. Now, obviously, energy and greenhouse gas emissions are the two topics, as well as associated metrics, that most companies who want to do climate-related disclosures would actually find material topics under the GRI process, and therefore include it in their sustainability report. So what GRI did was they updated the energy 2016 version to an energy 2025 version, which they now call GRI 103. And then they also updated the emissions 2016 version, expanded it very significantly from just scope 1, 2, 3 emissions to an entire climate change reporting standards. And they've renamed it as Climate Change 2025. So the greenhouse gas emissions, scope 1, 2, 3 part, the requirements has been subsumed into the new GRI 102 as just a small part of it, which we'll see very shortly in the next couple of slides. So for the GRI 103 Energy 2025 standard, which you see on the left-hand side, so this is a screenshot of the content page of both the old and the new versions of the energy standard. What you will notice straight away is at the very top on the left-hand side, you see that the management disclosure now has included a new requirement called energy policies and commitments. And I'll go through that in detail in a while. The other thing that you might have noticed is the disclosure 302 on the right-hand side for the old standard. The reductions in energy requirements for products and services has been entirely deleted from the 2025 version of the standard. And then the third thing that is quite obvious that I wanted to point out is disclosure 103-3, upstream and downstream energy consumption. That is basically a renaming of the old energy consumption outside of the organization. And in fact, it is actually not just a renaming, but it also actually includes some differences, including the need to list upstream and downstream categories in which significant energy consumption occurs. So this was not something that was required in the old standards. We will not go through all of the changes in both of these new standards in detail because it will take too much time. So tonight, again, I'm just going to highlight some of the big pieces, which I think is very important for companies and preparers to realize, because it is going to significantly impact how they do things. Okay, so jumping into a bit of finer details. For the management disclosures, we just said that the energy policies and commitments 103-1 is something that's new. So in it, there are two requirements. which is one to talk about energy-specific policies from the company. And then the second part, which is to talk about transition to renewable energy. So these two requirements were not included in the old version of the Energy 2016 standard. What was in the old version is the text that I've highlighted in purple at the top, which is to use the more generic requirements in GRI 3 pertaining to disclosures that you should make for the material topics that you have identified as a company, and which basically applies to every single topic, every single material topic they have identified. Now they have added two specific requirements for companies to disclose on their energy policies and commitments. Now, then I've also mentioned just now that the reductions in energy requirements of products and services from the old GRI 302 Energy 2016 standard has been completely thrown out the window. So for all companies that were previously preparing, their reports, they would have included this part. So for the new standard, they can pretty much delete everything and no longer need to collate this data and report it. Now, again, we're not going to go through all of the line items, but what I did notice is compared to Energy 2016, Energy 2025 topic standard has expanded its focus on renewable energy. And in the old standard, what they really wanted you to do was basically just to disclose the fuel consumption within the company. So you see that on the left-hand side table under the first row, GRI 302-1B, right? And there's a need to identify the fuel consumption from renewable sources. And then the second part is GRI 305-2.3.4. They did mention that for reporters who come from markets, energy markets that has contractual instruments, for example, like RECs. There are also other names for renewable energy certificates in other jurisdictions. But basically, all of these are contractual instruments that stipulates purchase of electricity from a specific supplier or power generator. And thereby, very often in the contract, they will give you specific emission factors that you should use in your carbon accounting. So then this results, for those of you who are familiar with GHG protocol, this results in your scope 2, the market-based method having a different number from the location-based method, which is based on the grid emission factor. And previously in the old standard, this was the only thing that was really required related to renewable energy. Now, take a look at the 102 Energy Standard 2025. I've extracted all of the requirements that mentions renewable energy, and this is the entire list. You will notice right at the top that the new requirements actually requires qualitative discussion on energy transition and its associated impact. And then for 3 of the line item requirements, you actually need to disaggregate the data between renewable and non-renewable energy sources for fuel consumption, purchase of electricity, and self-generated electricity. And you also need to break down the activities for all of these 3 disclosure requirements as well. And we'll see an example table of that later on when I do the case study. So just hold that in your mind for now. And then the last thing I want to highlight is, now, instead of just, remember the previous slide, there was a mention that you should disclose market-based scope 2 number for companies that operate in markets with contractual instruments. That was the previous requirement. Now, under the new requirement, GRI 103-2E, you actually need to talk about the second line there in the table. You actually need to talk about how the contractual instruments adhere to quality criteria to ensure accuracy and consistency. Now, this quality criteria is actually explained in the standard document itself under the guidance notes. But basically, it is taken from the GHG protocols, Scope 2 quality criteria for contractual instruments like RECs, which is found in Chapter 7, Table 7.1 of GHG protocol, the Scope 2 guidance documentation. So that's for the Energy Standard 2025 compared to the Energy Standard 2016. What about the Climate Change Standard? So this is the big one, right? The Climate Change Standard really changed a lot of things. Right off the top, again, you'll notice that for the management disclosure, there are two new items there that did not exist in the old version on the right-hand side at all, which is to disclose very specifically your transition plan for climate change mitigation, as well as your adaptation plan. So transition and adaptation is slightly different. Transition, as most of you will know, refers to the switch to lower carbon economy. And adaptation is more of like reaction to climate change events like extreme weather and all that. Maybe shift your factory from the coast to nearer inland in order to avoid flood damage, things like that. So that needs to be spelled out, and I'll go into a bit more detail later on. Then the second part, which I will emphasize and spend a bit of time talking, is this concept of just transition has been introduced in the new GRI 102 Climate Change 2025. And this is an entirely new concept that's not found in, as far as I know, any of the other standards and frameworks. Right, so I'll spend some time discussing that. So greenhouse gas emissions targets has also been introduced into the new climate change standard. And then the very bottom of the content page, I also wanted to highlight that there is now a section on greenhouse gas removals in the value chain. So the word value chain is a bit misleading. What is actually referring to is the organization's greenhouse gas emissions itself, how you go about removing that. For those that are in the actually in the upstream and downstream, which is scope 3, there is it's not actually part of 102-9. And then I also wanted to highlight in this session that there is a very, very big change to carbon credits disclosure, which we'll also go into detail in this session. So very quickly, the very first part, GRI, right at the top, the management disclosure. So 102-1 transition plan for climate change mitigation. You can see the screenshot that I've taken here from our standards documentation. The details required is quite a lot. So we won't go through them line by line. But the key thing to note is this disclosure of a transition plan for the organization is now mandatory. It is compulsory. And if you look at the bottom left of the screenshot, I've just highlighted and circled requirement J. If you look at requirement J, it says that if your company does not have a transition plan, you have to explain why it does not exist, and you must describe the steps taken to develop one and the expected timeframe in which you will finish developing one and therefore subsequently disclose it in future reports. So that's the first big biggie. Then the second one that I wanted to highlight is this whole transition plan must also take into account impact materiality, and therefore you must describe the impacts from the transition plan itself and the actions taken by the company to manage them. So you see I've highlighted requirement H, which is describe the impacts on people and environment from implementing the transition plan and the actions taken to manage them. So that includes workers, communities, as well as biodiversity. Then the last one that I wanted to highlight is again this concept of just transition. So requirement G here says that the transition plan must align with just transition principles and how engagement with stakeholders informs its development and implementation. So engagement with stakeholders is not new to people who are familiar with GRI. It's part of the whole take into account a broad-based views from broad-based stakeholder views concept behind GRI. But this concept of just transition is entirely new. I cannot find it in ESRS. It's certainly not in the ISSB standards, which I'm a lot of you would know I'm very obsessed with. So what is just transition? Now, GRI actually took this concept, they claim, from the 2015 Paris Agreement. This concept actually was brought about, and the International Labour Organization, ILO, describes just transition as greening the economy in a way, there's a typo here, it should be in a way that is as fair and inclusive as possible to everyone concerned, creating decent work opportunities and leaving no one behind. So what does this actually mean in concrete terms? Again, I took a screenshot from the actual standard documentation. What this means is you see a whole list of requirements here. Now, basically, that whole list of requirements reads like the old diversity and equality metrics, as well as the employee training numbers that typically comes when you have human capital, or employee welfare, employee training as one of your material topics in your reporting. The only difference is this time around, all of these numbers is not for the whole companies, all of the employees. It is only pertaining to those employees that are affected by the company's climate transition plan and adaptation plans. So it is a subset it is bunch of statistics that is a subset of the whole company's HR statistics. The company must identify the employees who are affected by the company's climate change transition and adaptation plan and isolate those numbers for this particular disclosure 102-3. So I'll show you an example of it in the case study later on. So keep that in mind for now. So this is a very big change with a big set of numbers. Now, what about carbon credits? I mentioned just now, right at the bottom of the content page, that they've introduced this whole new section on carbon credits. In the old GRI emissions 2016 standards, the only thing that was related to carbon credits, if you do a search, is right at the right-hand side bottom, the first row, 305-1.2. They mentioned that if offsets are used by the organization to meet the targets, then you must talk about the type, amount, criteria, and scheme of which the offsets were part. And then GRI 305-5A, says that if greenhouse gas emissions are reduced as a direct result of reduction initiatives, then you must report the reductions or offsets separately. Those are the only things in the old 2016 version of the emission standard that alludes to disclosures on carbon credit. Now, what about a new version? These are all of the disclosures that are needed. And when you look at B and C especially, you see project name and type, project type, cancellation serial number. There's a lot of details required regarding the carbon credit itself. Then they also have to disclose how the project adheres to the quality criteria like additionality, credible baselines, permanence, leakage avoidance, blah, blah, blah. But I really wanted to highlight the last part, which is E. You must describe the impacts on people and environment from projects where carbon credits are purchased and how the organization continuously monitors and evaluates them. So if you look at 1 to 5, requirements, sub-requirements 1 to 5, categories of stakeholders consulted in project implementation, how human rights are respected, how social economic benefits are provided to local communities and indigenous people, how biodiversity is conserved, and how trade-offs are assessed. When you think about it, if you are the preparer, you are the company, you bought a certain carbon credit, all of these details pertaining to how the local people or the biodiversity was affected by the project from which this carbon credit is derived, all this information must come from the carbon credits project owner. But the preparer, the company that is doing the reporting, is being asked to disclose all this. So what it means in practical terms is, as a company that has bought carbon credits, you need this close coordination with the project owner from which the carbon credit is generated. You have to find out all this information from them, and you must also monitor and continuously monitor and evaluate it, which I think does increase quite a lot of burden on the companies who buy carbon credits to do offset. Okay, let's jump into the case study. I have chosen to use City Developments Limited as a case study because, as those of you who are based in Singapore would know, CDL's sustainability report is one of the top ranked in Singapore, if not usually the top. And even globally, at one point, I believe it was also ranked top 50 or top 100 globally. So by taking a company's sustainability report that is ranked amongst the best, and then pointing out the amount of work that they need to upgrade in order to fulfill the new climate change and energy standards for GRI, I hope to show that any company, any normal company that usually performs sustainability reporting at a lower, impressiveness than CDL would have to do even more than CDL has to do in order to meet the new standards. So what I will do is I will discuss the energy usage disclosures and show what they need to update it with, as well as the climate transition plan disclosures, the carbon credits related disclosures, and the just transition disclosure requirements. So let's jump into it. So on this screenshot, you see how CDL has done their energy usage disclosure. They've disaggregated data by corporate office, managed buildings, and construction sites. And in the legend, you see that the colors, they stand for solar power, renewable energy certificate RECs, fuel, which presumably refers to fossil fuel, and purchase electricity. So this is the current breakdown of how to show their renewable energy generation and usage. under the new GRI Energy 2025 topic standard, they would actually have to disclose and disaggregate the data like this. And off the top, what you notice is new is they must break the usage down to renewable energy versus non-renewable energy sources. And not just these two categories, but within each of these category, they must also disaggregate it into the energy source, which probably for renewable energy, hydro or solar or wind power, etc., etc. So for both of these example templates, which is taken from the GRI standards itself, it is shown there quite clearly. The great thing about GRI standards is easy to read and easy to use. The guidance is very clear, and they will give you example templates, as opposed to maybe say IFRS documentation. And the second thing is on the left, I've highlighted. You see, for the fuel consumption as well as the self-generated renewable electricity consumption, GRI now requires the company to break the information down, not just by the type of energy, right, but also the activity that consumes the energy. So again, this is a big change in the way that the data is being collected and disaggregated in the actual report. Now, what about the transition plan disclosures? A few slides ago, I've said that this whole transition plan thing is something new. It does not exist in the old, the emissions 2016 standard. So under the new GRI 102 climate change standard, one of the requirements is to talk about the company's transition plan. Now, CDL, again, is one of the leading preparers of reports. So they are quite advanced. They have 3 entire pages talking about climate transition plan. You'll find it in their report in page 31 to 33, which I will flash very briefly here. So this is the transition plan. They spend 3 full pages talking about it. But even within that, you see on the left-hand side in the screenshot, I've checked off all the requirements they have met under their current 2025 report. There are 3 in particular that they need to update it with in order to meet the new Climate Change 2025 standard. The first one is 102-1C. They will actually need to report the total expenditure by the transition plan and the absolute amount as well as a percentage. So that is requirement C that I highlighted in a circle. So I've marked it with a circle in red on the left-hand side of the screenshot. What does this mean in practical terms? This means that this information must come from the company's finance team. And increasingly, as I've told a lot of my attendees of my courses, with the ISSB standards focusing on financial materiality, the involvement of the finance team in the company on providing the numbers for budgeting and anticipated financial effect from climate-related risks and opportunities will become greater and greater. Now, with GRI now also stipulating in its requirement that you must give the total expenditure incurred by a transition plan and break it down into percentage of total expenditure versus absolute amount, so much more the finance team or company needs to be involved, because definitely it is the accountants that you're going to go to for this information. And then the second thing that I wanted to highlight is 102-1H. You'll notice in this transition plan, GRI specifically asks for descriptions of the impacts on people and environment from implementing the transition plan and actions taken to manage them. So that's missing from CDL's 3 pages at the moment as well. And then the last thing is 102-1I, in which the public policy activities of the company, including lobbying activities, the company must describe how it is consistent with the transition plan. So again, this is now currently not part of CDL's climate transition plan disclosures within their 2025 report. Okay, we're going to jump to carbon credits now. So on the right-hand side, I've again replicated a screenshot of the 2025 new GRI climate change standards carbon credits disclosure requirement. What does CDL have at the moment in their 2025 report? What they have is they mentioned that they bought blue carbon credits from Climate Impact Exchange here in Singapore. And they gave some rough details as to the extent of the mangroves that were included in the project and how it benefited 42,000 members of the local community. That was pretty much it. And this information was repeated in a couple of other parts of their sustainability report. And then the other part that was relevant to carbon credits in their report is they mentioned that their carbon credits quality criteria was basically in line with both GHG protocol as well as another protocol called the carbon neutral protocol. And that was it. If you look through their 200 over pages of their CDL sustainability report, these are the only parts where they talk about their carbon credits. So in moving to the 2025 requirements of the climate change standard, they will then have to disclose all of those information for the carbon credits that they've used on the right-hand side in the screenshot. So that is going to be a lot more effort to collect those data and collate it. So you can see how significant the changes are. Okay, and then moving on, what about CDL's human capital disclosures? Now, this is the current breakdown of what they show. Nothing new. Many companies have it these days. It is actually a Singapore Exchange requirement in any case to show human capital statistics as one of the mandatory, or rather not mandatory actually, recommended topics. So most companies will have this, right? You break down employees by gender, by demographics, the turnover, the number of people that underwent training, blah, blah, blah. But again, this is for the company as a whole. As I've explained just now, under the new Climate Change 2025 GRI standard, they actually need to do this as a subset for those employees who are affected by their climate change transition and adaptation plan. So on these two screenshots, these two tables, you notice on the left-hand column, those are the line item requirements that is spelled out by 102 Climate Change Standard 2025. And this information needs to be disaggregated by gender as well as by employee type. So again, these two example tables are taken from the GRI 102 standard documentation itself. Under the appendix, they have example tables. So from what you saw previously, what CDL does now, they will then have to extract this as a subset for employees who are affected by their climate change transition and adaptation plan, and then be able to show the numbers that looks something like these two tables and disaggregate it accordingly. So again, major effort involved. So that's the extent, just very quickly. That's just the few things that I've picked out to talk about in today's session. Again, there were a lot of changes to the line items, and therefore there's actually a lot of work that needs to be done for almost every single company using GRI today to update their sustainability report in line with these two new topic standards. Okay, let me pause here very quickly before I go on to interoperability issues. There is a question from Shakil that I'll answer first. So the timeline for implementation of these revised standards is reports that are published on or after 1st January 2027, which means that the data that is collated and the period in which the report pertains to is for FY 2026, next year. So next year, all companies using GRI have to start using these two new topic standards. And then when they publish the report in 2027, it should be the requirements and the disclosure should be according to these two new standards. Whether any specific industries has been identified or prioritized to demonstrate compliance, no. But they do have a case study in the paid course that I talked about earlier at the start of the webinar. They do have a case study based on I think it's a Swedish or Norwegian company called OSTAT. But there is no specific industries that is prioritized. These standards are being issued and it will apply across the board for all companies using GRI. Ines, you have this question about addressing a demonstration of transition. I'm not too sure whether I'm interpreting your question correctly. Maybe towards Q&A at the end, we could have you come on the air and clarify what exactly do you mean by demonstration or transition. But the whole concept of just transition basically comes from the fact that GRI, they are born out of impact materiality. So you will notice in these two new standards, they kept emphasizing, even within the course that I took, the paid course that I took, right? They kept emphasizing that the difference between them versus other standards like ISSB standard is, with this revision, they also want people to talk about the impact of the climate change transition adaptation plans on biodiversity, environment issues like biodiversity, and on human rights issues, like indigenous communities and the labor force. So that is kind of what they're trying to do with just transition. They're trying to show that they are different, but at the same time, publicly, all of the standards, ESRS, GRI, and ISSB, they're all saying that they are working with each other to align with each other and demonstrate interoperability. But the reality is, when you read the actual standard documentation and look at it, it's actually um, they're still trying to differentiate themselves from each other. Uh, I have Ines on the air. Ines, are you able to unmute?
Yeah, I think so. You hear me, right?
Yes, go ahead.
Cool. No, I was just I'm being a little bit surprised that
Mm,
GRI is actually now incorporating, from what I've seen, that IFRS as well, the
mhm.
requirements on the transition plan, and start making it a little bit more structured. So I just didn't see it coming, and now it's very, very clear that it is there.
Yeah, good point. So I would show you guys in a while the difference between the GRI and ISSB standards requirement in regards to transition plan disclosure. So you see that you are right. GRI is trying to impose a lot more detailed disclosures than ISSB. It's almost as if they are trying to one up on the ISSB standards. So so we'll see that in a while in one of my slides. So maybe let me go on for not one wrong. Wanrong, I'll address your question at the end of the session. That's a bit more generic. Um, Rohit, your question on climate scenarios is upcoming in one of the slides as well. So I'll leave it for now as well. Okay, so currently on your screen, what you see is a screenshot of this comparison document that they released a while back, even before the two standards were confirmed. So this was based on the original draft proposal of the changes to the two standards. And I'm the table is actually 2 pages long, so I did not replicate everything. But what I wanted to highlight is the way that they position this table, how they compare it to the other major standards and framework. You can see from the boxes, this other standard has this, this other standard doesn't have this. And then on the left-hand side is all the new requirements under the GRI climate change standard. They are basically trying to show you that they are more comprehensive than the other major standards and frameworks. And if you go through, so the other standards and framework I've highlighted on top is CDP, ESRS, IFRS S2, TCFD, and the US SEC requirement. But basically, you will notice that if you look at the bottom of the screenshot, you see the impacts from adaptation plan on people and environment. It is blank for all of the other major standards and frameworks, right? And it is blank also for a few of the other line items. But basically, GRI is trying to say that the impacts on people and environment due to adaptation plans, GHG removals in the value chain, and carbon credits purchase, GRI 102 Climate Change 2025 is the only standard out there that includes disclosure for all this. Right? So they tried to show that with the table. And also under just transition, the percentage of locations with community requirements, they had this line item that is not found in any of the other standards and framework. If you're interested, you can download this comparison document from the GRI website. It is in their project page when they first announced the proposal to update these two standards to 2025 version. Now, I want to highlight, so they are there is no complete document that compares IFRS S2 versus GRI 102 yet, but I want to highlight a few key differences that I've spotted from myself studying the standard as well as taking the paid course. The first one is carbon credits. This is very important because a lot of people, when they look at the ISSB standard, they do not notice this because ISSB was the first and currently still the only one that requires it, which is ISSB standard actually talks about the planned use of carbon credits. They do not require disclosure of what you have already used, even in the last financial year. They want you to disclose what you intend to use in future in order to meet your greenhouse gas emissions reduction targets. So this is a bit tricky because it requires a company to think ahead and say, we think we will buy maybe 30, you know, kilotons of carbon credits in the future, which is a bit tricky. I think a lot of companies will be hesitant to disclose that and commit themselves to it. But if you look at the GRI 102 climate change standard, which is on the top left, if you look at the purple highlighted part, right, the requirement is very different. They require you to disclose details on carbon credits that the company has already cancelled, which means already used in the previous financial year or maybe even before, right? Presumably in the previous financial year, once there's a year-to-year usage of the standards. So this is very different. GRI wants you to talk about the carbon credits you've used. ISSB standards wants you to talk about the carbon credits that you intend to use in the future. So again, I'm not too sure whether they're intentionally trying to differentiate themselves, but for all preparers who intend to use both standards to prepare their report, please be aware of this. And in Singapore, that will certainly be the case because under SGX RECCO's requirements, most companies will end up using both GRI as well as IFRS S2 for climate change related disclosures. Now, the second major difference that I want to highlight, which Rohit asked about, is climate scenario analysis. Now, in the GRI standard, this current GRI 102 2025 version, the only place where they talked about climate scenario analysis is in this adaptation plan part where they say that the source of the climate change related scenarios use the temperature projection included in scenarios and the methodologies and assumptions used to develop the adaptation plan must be disclosed. That's the only thing they asked. They did not say that you must do climate change scenario analysis. They mentioned that you should disclose all these details as part of a disclosure. But in comparison, IFRS S2 has a list of very detailed requirements in regards to climate change scenario analysis. There's a very broad band. For those of you who have taken my training on my online course, you know this part, right? There's actually a lot of bandwidth for a company to do climate change scenario analysis, but the amount of details that disclose about the process in which and the assumptions behind how they did what they did is quite onerous. I had to kind of overlap and squeeze it here. So again, I won't go through the details. We are closing in on less than 15 minutes. I do want to save some time for Q&A as well as for Joyce to jump in and give some comments. And then the third major thing that I've noticed that is different between GRI 102 and IFRS S2 is this itself, GRI actually spoke about very clearly in the paid course, which is in IFRS S2, disclosing a transition plan isn't mandatory. So on the left-hand side here on the screen, you see the transition plan disclosure requirements for GRI 102. On the right-hand side, I've highlighted the requirement, actual requirement IFRS S2. They say that you should disclose any climate-related transition plan the entity has. But they didn't say that you must have a transition plan. Whereas if you compare it to the GRI 1 on the left-hand side, the organization shall describe its transition plan, including policies and actions to mitigate climate change. And then under H, which is highlighted at the bottom, again in purple, they asked you to explain why you do not have a transition plan if you did not have one and when you're expected to come out with one. So GRI in its paid course emphasized that in this new climate change 2025 standard, having a transition plan disclosure in your sustainability report is a must. Whereas in IFRS S2, they pointed out is not mandatory. So this is a key difference. And then they ended by saying in the paid course that there is no detailed mapping documentation to compare IFRS S2 versus GRI 102 yet, but they will publish one unilaterally, which means the analysis will come from only them and not in coordination with IFRS Foundation. They will unilaterally come up with a mapping documentation for S2 versus GRI 102 eventually, although they didn't say exactly when. Now, very quickly, 2 minutes on ESRS. Tonight, we are not really going to talk very much about comparing ESRS 1, which is on climate change, to the new GRI 102 standard, because as most of you know, with Omnibus 1 proposal having came out in March and the whole consultation process going on until the later part of the year, what will happen to ESRS is not very clear yet. There's a lot of facts, there's also a lot of rumors, but basically what I've gathered is this from, again, primarily from the EU's website itself. There is clear indication that they'll remove around 80% of the company previously subjected to mandatory reporting under the CRSD regulation. they've also alluded to the fact that they will reduce the mandatory data points by at least 50% from what is currently required. So the climate change topic standard for ESRS currently has 217 data points, some mandatory, some subject to materiality assessment. So we expect that maybe that will come down by about 50% or maybe a bit less because climate change is such a big topic. Sector-specific standards will be cancelled. There will be clearer instructions on double materiality, and the standards structure and presentation itself will be simplified. So at this moment, it is not possible for anybody to do a good comparison of ESRS to GRI 102 because the comparison will probably not be useful in another 3 to 6 months' time because again, the data points will be reduced by about 50%. So there's no point doing a comparison right now. So that's why in the paid course, GRI itself did not compare GRI 102 climate change to ESRS. They only compare it to IFRS S2. Okay, and with that, I will hand some time over to Joyce to quickly introduce herself while I digest the questions.
Hello, everyone. Can you hear me? Yes, good. My name is Joyce. Happy to join LAN's at CSO Center. I'm a training consultant in environmental topics, so decarbonization, sustainability, primarily carbon and RECs markets. I am also an accredited trainer by Singapore Institute of Banking and Finance. So we're teaching our colleagues in the financial industry in similar topics. So for the bankers, for instance, when they take our courses, they can earn professional development credits from the IBF accredited courses. Before joining CSO Center, I was at CIX and SGX, Singapore Exchange. When I was with SGX about like 10 years ago. No, sorry, not 10 years ago. So back in, I was at SGS for 10 years. And then at my 10th year in 2021, so Singapore government wanted to set up a carbon exchange in Singapore and basically establish Singapore as a carbon trading and service hub in APAC. So then Climate Impact X was established that year by 4 main shareholders. There's Temasek, that's Singapore Sovereign Wealth Fund. I think a lot of you are familiar. There's Singapore Exchange, where I came from. Lance was my previous colleague back at SGX. And there were also 2 other banks, DBS and Standard Chartered. So these were the 4 main entities that set up CRX. So naturally, you can see that there are employees from the shareholders like myself who decided to literally venture into greener pastures to set up CRX from scratch. Back then, I would say carbon is really very new in Asia. Singapore was one of the first few in Asia to have a carbon exchange set up. So we do quite a lot of speaking at the public forums, guest lecturing and education to generate awareness, as you can see from some of the photos here. And when CI started off, it was only in carbon markets, but very often back then, we would receive queries from clients asking, like, do you also offer RECs as well? Some corporate clients would actually confuse carbon credits with RECs. So that is when CIX decided that we're going to just expand the product offering because all these are environmental products. For myself, I really enjoy teaching and sharing the knowledge because I find that it's a two-way street. I'm always learning new things from the participants because this space is constantly evolving, like what Lance is sharing about new disclosures. So I love to hear also from the participants about their experience, what's the industry approach on decarbonization pathways. From, I think just now what Lance shared with regards to climate change in GRI, there's also like one more part. There's a table that you also need for the holders, I would say, or those who are holding carbon credits. Not only do you need to disclose what you have, the credits that retired, but you also need to disclose your inventory, which means credits that you have holding but not yet retired. So I guess this is a push for greater transparency, especially when if we see a lot of the large corporates, instead of just purchasing carbon credits and retiring them, a lot of them will go upstream and then they will invest in their own carbon credit, carbon projects, whether it is for their own use and maybe potentially if they have access, they may sell it to the market. So with these sort of disclosures in the new GRI standards, then that will provide the market with greater transparency. All right, that's the end of my presentation. I'll pass over back to Lance.
Thanks, Joyce. So we are doing great in terms of time management. There is just one question from Wenrong that is she wants to know if it's possible for companies to abandon GRI and move over to IFRS S1 and S2, given how complex 102 and 103 is. I will probably edit this out of the recording, but I will say this in the live session, which is a contact of mine has told me that there are big corporates considering switching entirely over to just using ISSB standards and financial materiality because it's becoming too much of a burden for them to juggle both impact materiality based standards and a new mandatory reporting requirements, which is based on financial materiality. I don't know to what extent his insights is accurate because I've not heard it firsthand myself from any of my clients or corporates. But I would imagine that it's entirely possible because since a year ago, I have also privately commented that a lot of, you see, what ESRS, why Omnibus came about was because after the first year of implementation, the European corporates came back and basically protested and say it's too onerous and too big a burden for most of them to be able to comply with it. Therefore, the EFRAG was forced to the regulatory authority was forced to consider scaling back the scope and scale of their sustainability reporting requirements, in addition to a whole bunch of other sustainability regulations that they have, like CBAM and the taxonomy, EU taxonomy. So really the reality is coming true. What has happened in the sustainability reporting space was we went from about 600 over different provisions for reporting. So a lot of different standards and frameworks. We went from many to an oligopoly of a few, which is basically GRI, ESRS, and ISSB. And then there's US SEC, which is now indefinitely on stay and likely to be rolled back. So let's not talk about that. But basically, an oligopoly of a few major standards for mandatory reporting, which seems to be adding more and more requirements. As you can see from this change to the GRI energy and climate change standard, as you can see from those of you again who has gone through ISSB training with me, they extend all the requirements. ISSB also scaled back the requirements for finance emissions when they got industry feedback on how onerous it is. So I think it is entirely possible that there'll be some corporates who will consider just reporting whatever is required under mandatory reporting regulations, which seems to be largely just using financial materiality right now. There are only a few countries in the world, according to GRI, that mandates compulsory use of GRI standards. I think one of them is Taiwan, if I recall correctly. There is probably 2 or 3 in the world. But by and large, GRI is being used voluntarily by most companies and most countries in the world. So it is entirely possible that some big corporates or smaller corporates may consider dropping voluntary reporting using an impact materiality standard like GRI. Personally, I think that impact materiality is important, but it's just like how a citizen should be accountable to society for its actions. So those of you that took Law 101 knows that a company, a private limited, is considered a legal entity and persona on its own. So I think a company should also be accountable for its actions that impacts the community and the world at large in terms of environmentalism as well. But I think that should be regulated by the government, not by the financial market. So for stock exchanges, I think by and large, the financial community, it makes sense for them to use standards that focuses on financial materiality, the financial incentive for companies to do mandatory reporting. And as for those impacts that a company creates on the community and the rest of the world, really, I think that should be more effectively regulated by the government and impose that, on not just listed companies, but any big company or even smaller ones that have a substantial pollutive or societal impact. So I think it's possible. Yeah, a very long-winded answer. I was hoping that someone else would come up with other questions, but there's been no other questions, so I assume that either everyone is suffering from indigestion from the amount of updates to the GRI standards, or maybe I didn't do a very good job explaining it and you're a bit confused. Either way, we are coming near to the end of the session, so there's about 3 minutes left. Thank you everyone wherever you are in the world, whether it's morning, afternoon, or evening, for joining us today. We won't do this very often, but I really thought that today's session is going to be very useful to, again, a lot of my friends and former clients, because the changes are very substantial. And I hope that I've achieved my goal of showing you just how substantial the updates and the changes are. Again, I intentionally use CDL as an example because their report is one of the best and most comprehensive, even by global standards. And if even CDL needs to do so much updates to their sustainability report in order to meet the new climate change and energy standards from GRI, so much more than the smaller mid to small cap listed companies that has to do mandatory reporting under the listing requirements of most major exchanges in the world. So I hope I've impressed that upon you. Those of you who are actively involved in sustainability reporting within your companies, or those of you who are consultants, or maybe in the accountants who are doing audit, these two new standards is a very, very big landmark change. It's very seldom that I don't think there has been anything as significant in recent years, apart from the release of IFRS S1 and S2. So do take a careful look at it. Of course, most of you, again, are not strangers to me, so feel free to ping me or to email me if you have any questions. But for those of you who might be hearing from us for the first time, this is my contact as well as Joyce's contacts. So she's the in-house resident expert on carbon markets. If any questions pertaining to that, feel free to approach her. I'll leave it on screen for a moment for you guys to scan and add us via LinkedIn or copy down our email address if need be. Otherwise, for the rest of you who already have my contact and Joyce's contact, feel free to drop off. Thank you very much. Sorry, I just be reminded there's been someone anonymous asked for companies that are lost. What's the most important issue to tackle now based on the new changes? Take credible training courses and get yourself updated on the implications and the new requirements. I think that's the most important thing now. As I often say, sustainability standards are the rules of the game. If you don't start off your reporting by knowing the rules of the game, then at the end of the year, when you prepare your report, you'll find that you do not have the right data, you did not collect the right information and have the right workflow, you will not be ready to report. So you should start doing it at start of the reporting cycle, understand what these standards require of you. Standards are also effectively the way to plan your sustainability management strategy, because it spells out everything very clearly, the whole thought process and what you should think about. So that, I think, should be the first step for any company. Okay, our time is up. If there are no more questions, thank you everyone once again. A very good afternoon, good evening, and good morning maybe to some of you from across the other side of the world. Thank you for attending, and hope to be able to catch up with most of you in person in the year to come. Thank you.
Bye.
Bye-bye.
Hey.